Welcome back to the show. Let's check in on some macroeconomic data for today. Had a few data points that are meaningful today. A couple of housing data points. As always, on Wednesday at 7 a.m., we get the Mortgage Bankers Association mortgage applications for the week ending the prior Saturday. So for the 13th, up 3.9%, better than the week before. 30-year mortgage rate 6.87%, down from 7% again in the prior week. Not bad. Back below 7% on 30-year mortgage. Also today, we had the June housing starts. Came out 1.353 million units on an annualized basis, better than expected, better than May. Percent change up 3% from May, compared to down 4.6% from April to May. So not bad. Building permits up 3.4% to 1.446 million units. Good news on the housing front compared to May, although we're still near lows of the pandemic when it comes to housing starts. If you go look at a chart of housing starts back to the 1960s, we were last at these levels 2018, 2007, 1993. So we're near lows. We're still well above the lows from COVID 2020, which was 1 million units on an annualized basis. So not too bad, but some weakness in housing. Having said that, though, when you compare that to what's happening to interest rates, housing has been quite resilient. There's lots of complaints about mortgage rates up here at the 7% level, 6.8% today, 7%. But we've been here for a long time before that. In fact, from 1971 to 2001, 30-year mortgage rates were higher than they are today. Don't forget about that period from 1978 through 1986. Mortgage rates were well above this level. Obviously, these mortgage rates are related to the Federal Reserve's efforts to wring out inflation. So we connect Biden administration policy on igniting inflation in his first term, the Fed reacting to that inflation by raising rates, and of course, those higher rates impacting housing to the downside. But quite resilient. And what's driving resiliency in the housing market is really the financial services sector. This whole World Economic Forum stuff. The idea you will own nothing. We're going to be a rental world. We've had a massive inflow of money from financial services companies, some of the wealthiest, deep-pocketed financial services companies on the planet, buying up U.S. housing to then rent it out to Americans. In addition, we have this virus running through our housing market, which is the short-term rental market, the Airbnb, the Vrbo. Horrible for housing in terms of prices and affordability. So these are the two driving forces that's keeping housing elevated in a way it probably should not be if we didn't have that demand in the market. Also today, we had capacity utilization of 78.8% for the month of June, better than expected, better than May. Industrial production for the month of June up 0.6%, better than expected, a little lower than May, but still two good numbers. Again, go look at a chart of capacity utilization. You see that's a downward trend from the 1970s. Capacity utilization prior to the 1980s. And certainly late 70s was in the 90% range. Again, the percent of our capital stock in use. And now, of course, we are back below 80%. And that's our trade policy. Unilateral free trade policy under Nixon got started, Henry Kissinger, and just kept going by every successive president in Congress. Capped off by Bill Clinton in 1999 with the permanent normal trade relations with China, allowing China to enter the World Trade Organization, and it's gotten worse since then. Industrial production number, not bad. Of course, we're not making the same things we used to make 30, 40 years ago. So a mixed bag of numbers a little bit, but all better than expected, moving in the direction that doesn't warrant further rate cuts at this time. So just checking in on my favorite source for information. By the way, if you're looking for your financial news apart from me, you want to go with CNBC.com. My first stop is CNBC.com. My second stop is investing.com. My third stop is marketwatch.com. Now, there's a slew of financial service news pages, but those are my top three. I recommend them to you as well. Anyway, stocks down today after a massive rally yesterday, so some profit taking happening today. The S&P futures down 60 right now at 5,656. Market's going to open up here in just a moment as I'm recording. Oil, 81.85, no real movements, a little higher from yesterday. 10-year, a little lower, 4.182%. Remember now, when we think of bonds, we have an inverse relationship between bond prices and interest rates. I always talk in terms of interest rates. So if interest rates are falling, bond prices are rising and vice versa. Anyway, this data today doesn't change the outlook for the Fed. It does weaken the case for cutting rates in September. We have more data to follow. That's all I have for you today. Always try to buy American.